Have you ever wondered how one man became one of the richest investors in the world? His name is Warren Buffett. He started investing when he was just 11 years old. Today, his net worth is over $100 billion. But the surprising part is, he still lives in the same house he bought in. Born in 1930 in Omaha, Nebraska, Warren's interest in money started early. At just 6 years old, he was buying 6 packs of Coca-Cola for 25 cents and selling individual bottles for 5 cents each. That's a 20% profit. Not bad for a first grader. By age 11, he bought his first stock. By age 13, he was filing his first tax return, even taking a $35 deduction for his bicycle because he used it for his paper route. He didn't just want to be rich, he wanted to understand how money worked. This led him to Columbia University, where he met his mentor, Benjamin Graham, the father of value investing. Graham taught him the most important lesson of all. A stock isn't just a ticker symbol, it's a piece of a business. So what are the secrets behind his success? In this video, we will explore 5 powerful lessons from Warren Buffett that can change the way you think about money. Part 1. Start investing early. Warren Buffett bought his first stock at age 11. He later said, "I started investing too late." That might sound strange, but Buffett believes time is the most powerful factor in investing. The earlier you start, the more your money can grow through compound interest. Even small amounts can grow into big wealth over time. Part 2. Invest in what you understand. Buffett never invests in businesses he doesn't understand. This is called the circle of competence. Instead of chasing every trending investment, he focuses only on companies he understands. This simple rule helped him avoid many big losses. Part 33. Think long term. Most people want quick money, but Buffett believes real wealth comes from patience. He once said, "Our favorite holding period is forever." Instead of buying and selling constantly, he holds strong companies for many years. Part 4. Be greedy when others are fearful. During market crashes, many people panic and sell, but Buffett does the opposite. His famous rule is, be fearful when others are greedy, and greedy when others are fearful. This mindset helped him buy great companies at cheap prices. Part 5. Live below your means. Even though he is a billionaire, Buffett lives a very simple life. He doesn't buy luxury things just to show off. His philosophy is simple. If you buy things you don't need, soon you will sell things you need. True wealth is not about spending money. It is about keeping and growing it. If you don't find a way to make money while you sleep, you will work until you die. These are the words of the man they call the Oracle of Omaha. Warren Buffett is widely considered the greatest investor of all time. But he didn't start with millions. He started with a paper route and a vision. Today, we're breaking down the legendary story of Warren Buffett and the 5 rules that turned him into a billionaire. If you want to grow every day, this is the blueprint you've been looking for.
Warren Buffett's success didn't come from luck. It came from discipline, patience, and smart thinking. If you follow these principles, your financial future can change too. If you enjoyed this video, make sure to like, subscribe, and share this channel. Because on this channel, we talk about money, success, and powerful life lessons. See you in the next video. The Berkshire Hathaway Era. Visual chart showing the massive growth of Berkshire Hathaway stock compared to the S&P 500. In 1965, Buffett took control of a struggling textile company called Berkshire Hathaway. It was a failing business, but Buffett saw an opportunity to use it as a vehicle to buy other wonderful companies. He shifted from Graham's cigar but strategy, buying cheap, dying companies, to the philosophy of his partner, Charlie Munger. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He bought brands we all know, Coca-Cola, American Express, Apple, and Geico. He didn't trade them. He held them. The 5 rules of success. Rule number 1, never lose money. Buffett's first rule is, never lose money, and the second rule is, never forget rule number 1. This means managing risk is more important than chasing high returns. Rule number 2, invest in what you understand. If you don't understand how a company makes money, don't buy it. Buffett famously avoided tech stocks for years because he didn't understand them at the time. Rule number 3, be fearful when others are greedy. The stock market is a manic depressive. When everyone is panic selling, that's when the best deals are found. Rule number 4, the power of compounding. Buffett says his wealth comes from 3 things: being born in America, lucky genes, and compound interest. Most of his billions were made after he turned 65. Rule number 5, your reputation is everything. It takes 20 years to build a reputation and 5 minutes to ruin it. Buffett prioritizes integrity above all else.
The mindset, simplicity and reading. Despite being one of the richest men on earth, Buffett still lives in the same house he bought in 1958 for $31,500. He eats breakfast at McDonald's and spends 80% of his day reading. Success isn't about being a genius with a 160 IQ. It's about temperament. It's about having the discipline to wait for the right opportunity and the courage to take it when it arrives. Conclusion and call to action. Host: Warren Buffett's journey shows us that wealth isn't built overnight. It's built through patience, continuous learning, and sticking to your principles. 1. Never lose money bag. Emotional decisions equals loss. Invest smart today, your future self will thank you. Small decisions today create big wealth tomorrow. Don't just earn money, make money work for you. Patience is the real secret behind every successful investor. Start early, stay consistent, and watch your money grow. Rich people think long-term, now it's your turn. Your financial freedom starts with one smart decision today. If you want to level up your life, hit that subscribe button.
My dad had various nicknames for me. He'd call me Fireball sometimes because I'd start little businesses. He didn't care about money at all. He believed very much in having an inner scorecard and I never worry about what other people are thinking about you. You know, just if you know why you're doing what you're doing.
Honestly say that what makes me happiest is what I'm doing. I know I'll win over time. That doesn't mean I'll beat everybody else or anything like that, but I mean, the game is very, very, very easy if you have the right lessons.
When I was in high school, I really only had 2 things on my mind: girls and cars. and I wasn't doing very well with girls, so we'll talk about cars. But let's just imagine that when we finish, I'm going to let each one of you pick out the car of your choice. Sounds good, doesn't it? Pick it out, any color, you name it. It'll be tied up with a bow, and it'll be at your house tomorrow. And you say, well, what's the catch? And the catch is that it's the only car you're going to get in your lifetime. Now, what are you going to do knowing that that's the only car you're ever going to have and you love that car? You're going to take care of it like you cannot believe. Now, what I'd like to suggest, you're not going to get only one car in your lifetime, but you're going to get one body and one mind, and that's all you're going to get. And that body and mind feels terrific now, but it has to last you a lifetime.
Let's take Warren Buffett of Omaha, Nebraska. If you had put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today. Warren was a chapter in my 1972 book, Super Money, so I've known him a long time. He learned his trade with Ben Graham, the original dean of security analysis at Columbia University. I don't think Warren has ever been on television until this interview, and he has certainly never courted publicity, but recently he got a lot of it when he emerged as the key figure in the takeover of ABC by Capital Cities. Warren will be the largest shareholder of the new company, and his own net worth is now far in excess of $500 million. But when I spoke with him last fall in his office in Omaha, he very characteristically made his investment style seem so perfectly simple.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but You do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
So Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
That's terrific. How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's simply an intellectual process. Well, and the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad, but why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily, and you don't have to make any decisions. You have to make nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients are start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance?
Yeah, the data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.